What's going on, dividend chasers? It's the Dividend Bloodhound here, back with yet another investing episode. Today's episode, we're talking about how you can prepare for the next stock market crash. Super important video today for you guys. You really need to pay attention, as this could massively help you save and make money in the future. If that sounds like something you're interested in, stick around after the intro. Smash that like button for me as well, but if you find this video brings you some value, and consider subscribing to my channel as well. That'd be absolutely fantastic. See you on the flip side of the intro. Hey again guys, welcome into the video. So the next stock market crash can come from absolutely nowhere. There's a lot of fear in the market at the moment. I see a little bit of fragility in my humble opinion. There's a lot of fear around the US election, the global pandemic, an unforeseen black swan event, and the next stock market crash can come from absolutely nowhere, and it can gather momentum as quick as that, and all of a sudden your portfolio could be down 10, 20, 30, 50, or in the worst case scenario even more than that percentage wise. I'm going to tell you today some little hints and tips that mean that you can take advantage if such a crash happens. It's not even if, it's when, because there is one guarantee. In fact, there's two guarantees in investing. The market will eventually go up and you will make money as long as your time scale is long enough, and there is always a stock market crash coming. There is absolutely nothing you can do about a stock market crash coming. If it happens and you don't have all your positions in cash, then guess what? You're going to be affected by it. However, by watching this video today and following these little tips, you can mitigate the impact of it, and then you can take advantage and make some money as well. The first thing I'm going to say is, if you have any positions in cash when a stock market in the market when the crash comes, then the likelihood is you're going to lose a significant amount of money against those positions. If this happens, you should not panic and start flapping around, starting to try and sell your positions for double-digit percentage losses. Just stop and think and have a look at what your long-term strategy is. If you've got loads of time in the market, you have absolutely nothing to worry about from a stock market crash, as long as you have high-quality stocks. Historically, stock market dips and crashes don't actually happen that often. Even a 10% drop only tends to happen once a year. I say that historically because over this year, obviously it's been very volatile, but if you average that over the whole time period that we've got ahead of us and what we've got behind us, then it actually works out to be a 10% drop once every 10 months and a 50% drop in the stock market, which would be absolutely breaking and would be enormous news. That tends to happen only 2 or 3 times every century, historically, according to Seeking Alpha. So over your investing time of 20, 30, 40 years, you might experience only one of these huge stock market crashes, and guess what? This is, at the moment in the global pandemic, has been one of them, and who knows when the next one will come, especially with the markets being as fragile as they are. If you follow these 5 tips that I'm going to give you today, you can significantly reduce the risk to your portfolio and your investing, and in the long-term outlook actually hopefully make a serious amount of money, because a lot of people take advantage of stock market crashes to get serious value for money buying high quality stocks. Tip number 1 is you need to have an emergency fund. You should have this before you start investing, period. Never mind if there's a stock market crash on the horizon. You have to have, or you should have, it is recommended that you have at least 2 months of expenses in your bank account should the worst case scenario hit you, whether you lose your job or you have to pay for a boiler repair, damages to the car, etc. A lot of people recommend expenses of more than that, but it's really up to you and your situation and your job security for how much money you keep aside for that rainy day. But it is imperative that you must, because what you don't want to be doing is, if your portfolio does depreciate by 30 or 40%, the last thing you want to do is sell positions at that point at your maximum loss, because the dog needs to go to the vet, or your car has broken down, or the boiler needs replacing in your house. You do not want to be touching. That is the worst possible time to touch your money. So emergency fund is a number one priority as an investor if you don't already have one. Tip number 2 is that your portfolio should be diversified across multiple stocks and multiple sectors. In the last stock market crash due to the global pandemic, some sectors got hammered a lot more than others. Initially, everywhere was absolutely walloped. Your portfolio will have taken a hit, period. It doesn't matter what you were invested in. But then some sectors, the leisure industry, the travel industry, gas, energy, oil companies, they were walloped excessively hard by the pandemic, whereas other sectors haven't done so bad. The tech sector is absolutely flying at the moment. Food and drink also not actually doing too bad because you can get food in the supermarket. You obviously can take advantage of this drop, but also it's important to remember that some of your positions won't have dropped so far. You can also use dividend paying companies to mitigate some of the loss by earning some income back purely through dividends, not just through the appreciation of the shares. And it's a good time to buy into dividend stocks as long as they're good quality ones if they are dropped, because you get a higher sustainable yield, especially if they are dividend aristocrats and kings, that you get to keep forever at that price that you bought in at. Tip number 3 is to have a cash reserve separate to your emergency fund to deploy into the market and take advantage of any drops or average down any positions, as long as you judge and you do your research that suggests that that position and that stock is still great value. For instance, if Coca-Cola halved in value overnight due to a stock market crash that applied all across the board, a lot of people would want to take advantage of that price and lock in a really great dividend in a great company. It is of course okay to still dollar cost average invest, so you invest a little bit each month, but I personally would keep some money aside just ready to take advantage of that significant drop that appears in a company that you really want to get hold of. Remember not to compromise your emergency fund or confuse your emergency fund with the cash that you can use to invest in. Never compromise and run yourself right up to the wall your emergency fund just to get money into the stock market, because if the market falls further, you then can't get that money back out again. You need to keep that money. I can't emphasize that enough. Keep that money to one side and keep it safe. Maybe pull it in an ISA or something that attracts at least some sort of interest so you get something, but don't invest it because you never know when you're going to need it. Tip number 4 is to construct a watch list or a target list on the likes of Freetrade or Trading 212. You can do this immediately by just putting a little tick next to it of your most targeted, your top priority stocks that you want to get into. Of course, do your research, set yourself up a price target that you will buy in at. If you need the likes of Visa to fall 15% because that's where you want to buy in, that's your price point, then wait for that point and stick to your guns. Wait for the market to come down and crash and then buy in at that point. If it gets to 14% and you decide that is enough of a bargain for you, of course jump in, but you don't want to be just jumping in at a 2% drop or whatever. Do keep an eye on what your targets are. Set yourself up a nice little list that you can easily research, you can easily monitor, and that will be so easy when the next crash comes for you to take advantage of. For me personally, on this list will be your dividend aristocrats, your dividend kings, and high dividend growth stocks with a really, really good history. If these stocks drop due to a stock market crash and they go down 15% or more, even if it was 10%, that's still double digits, they are well worth pouncing on and keeping an eye on, in my opinion. The 5th and final tip today is write down your strategy for what you actually want to achieve in investing period, but especially within a market crash. Write it down. What are your targets? What are your goals? What are you trying to achieve? Because with the hype stocks that are out there and the next big trend and FOMO, it is very, very easy to get blown off course and start investing in the next biggest trend rather than looking for actual value for you to buy. With a written strategy, it is much easier to concentrate on your goals and what exactly that you're trying to achieve. You can sort of hold yourself to it, or even get somebody else to hold you accountable towards it. This is extremely useful over the long term. The sorts of things you need to have in this strategy and written down are: what are your actual goals? What's your risk appetite, your time horizon? Are you in for 5 years, 10 years, 30 years, 50 years? That is completely down to you, of course. Your actual goals, short, long term, medium, are they SMART goals? Smart, measurable, achievable, realistically and time bound? Of course, if you've already gone for the time horizon, then that's absolutely sorted already. Then you need to keep track of your progress. A lot of investors have spreadsheets to keep track of the companies that they invest in, what their yield on cost is, what their total return is, how much they've made to date period, whether that be over 4, 5, 10 years, whatever. So that is a really helpful tool. And then a lot of people actually blog their journeys on either an actual blog, through YouTube, through Instagram, and that is another form of being able to track progress, which is absolutely really good. And then if you happen to make a little bit of money off the YouTube channel on the side, then that's also great too. And that brings us to the end of this video, guys. I really hope those 5 tips can help you. The video has been an absolute pleasure to make. If you can consider liking the video, smashing that like button, and subscribing to my channel if you haven't already, that would be absolutely brilliant, and let me know your appreciation. It's been an absolute pleasure as always, guys, and hopefully I can see you in another investing episode. Catch you there.